Good afternoon. This is Sean Golding with Golding and Golding, here to discuss the basics of estate FBAR filing and penalties for not properly filing forms such as FBAR, FATCA Form 8938, and other international information returns. So, in the typical situation, what will happen is an estate will contact us, either the beneficiary, the executor, administrator, and it turns out that the estate still has various accounts and assets after the decedent passed away. Now, there's different aspects to the reporting. At this moment, there would be, was the decedent in tax compliance and offshore reporting compliance at the time he or she was alive? And the estate going forward, has the estate filed any returns necessary for the estate to file? And if so, has the estate filed the proper forms? So in a typical situation, the estate will come to us getting ready to file the final tax return of the decedent, only to learn that in reviewing the prior year returns, the decedent was not properly disclosing offshore accounts, assets, investments, or income on the tax return. So before filing the last return, uh, arrangements need to be made in terms of properly getting into compliance for the prior years, as well as the estate going forward. So the estate needs to take inventory and decide, or go through and see what type of assets, accounts, and investments the estate now has under the estate name. Uh, is there income from these accounts, assets, and investments, even if they're not reportable? For example, individual real estate owned overseas is not reportable, FBAR and FATCA, but the income would be reportable. And as a side note, you get the same deductions. You can even take depreciation, which sometimes you're not allowed to do in these foreign countries. Some of the common estate filing requirements, and important to note that even though these are primarily for individuals, estates would have to file them as well if they meet the threshold. So there's the FBAR, Foreign Bank Account Reporting, uh, technically known as FinCEN Form 114, or Foreign Bank and Financial Account Form Reporting. The minimum threshold is if there is an annual aggregate total of more than $10,000 on any given day of the year, then the FBAR is filed. It doesn't have to be per account, it's in total. So one account with $100,000 in it, 10 accounts with $1,200 in it. Once you exceed that $10,000 barrier or threshold, you have to do the full reporting of all the accounts and assets. Um, FBAR common accounts would include bank accounts, savings account, investment accounts, foreign pension, retirement, life insurance policies, things like that. There's also FATCA Form 8938 for individuals and estates, which is relatively new. Form 8938 requires the disclosure of certain specified foreign financial assets. There are different thresholds for the reporting as opposed to the FBAR, but it can get complicated when the trust, or when the estate, excuse me, is involved. So if there's an estate with foreign assets filing the return, they should speak with an experienced practitioner on that. There's also other informational returns that are common we find for estates, such as foreign trust reporting 3520A, foreign entity reporting Form 5471, and Form 8865. The former is for corporations, the latter is for partnerships. There's also possible foreign gift reporting on Form 3520. When there's offshore income, that income has to be reported as well. Now, oftentimes, there will be questions about whether the tax on the growth versus the distributions, and oftentimes you have to look into the investment to see if it's a PFIC, passive foreign investment company, see if there is any foreign tax credits that can be had if taxes were already paid overseas. But typically, the offshore income has to be included when the estate files a return in the U.S., both for the estate as well as the decedent's last return. As a side note, practice point, just because it's tax-free overseas doesn't make it tax-free in the U.S. It's very common that these foreign countries will have tax-free income. Uh, doesn't mean that it's tax-free in the U.S. You want to refer to the treaty and things of that nature. Um, a common situation is when the state doesn't realize for a few years that maybe when it filed the final tax return, or when it's filing its own returns, that they haven't properly reported the offshore accounts, assets, investments, and income on the U.S. tax returns. The IRS has several programs in place to assist with getting into compliance. Excuse me. Some of the more common programs are the traditional voluntary disclosure program, which is used for people who cannot certify under penalty of perjury that they're non-willful. It's still nothing criminal, just for one reason or another, the person signing it is not comfortable making a non-willful certification. Non-willfulness is required for most of the other programs, such as the streamlined domestic offshore procedures, streamlined foreign offshore procedures, delinquency procedures, and reasonable cause. This is an introduction to estate FBAR filing, penalties in Form 8938, as well as other international information returns. My name is Sean Golding with Golding & Golding. We have lots of free resources on our main website, goldinglawyers.com. Thank you for your time. Enjoy the rest of your day.